Hello and welcome back to the Money Advantage podcast. This is Rachel Marshall and Bruce Wayner coming to you today with special guest Mike Stanley. So before I say anything more about this show, I want to welcome everyone to the conversation. If you're joining us live, go ahead and give us a thumbs up in the comments and go ahead and tell us that you're here and what questions you might have or thoughts on the reverse mortgage. So Bruce, thank you for being with me today for this great conversation.
Yeah, this is a topic that I hate to use the word controversial because I don't think it's controversial, but I think people have it in their minds that years ago it had some stumbling blocks and things have changed since then. It reminds me of my grandmother who was born in the early 1900s, and she was a school teacher, and I used to have her book, and in the health section of the books, it talked about how to be healthy. And it said that you should air out your underwear every night and wash it once a week. And it also talked about taking a bath, every weekend. And so that was what was taught in schools way back then. And now if we would talk about that the same way, people would think we were crazy. All we're asking you to do today is to listen to one of the experts in the reverse mortgage situation, and then reach out to your competent financial consultant or advisor and see if it might fit into your situation. If it doesn't fit into your situation, or you don't believe about it or believe in it, then you probably should just turn off this podcast and go somewhere else and listen to some music. But just think about how you're thinking about something. And if you do, you might open your eyes up to something that has benefited even very affluent people nowadays.
Bruce, thank you for that. And so, Mike Stanley, thank you for joining us on the show today and coming back to talk about reverse mortgages and just really give the nuts and bolts and the facts and figures from your tremendous experience in this field. Thank you so much for joining us.
Thank you for having me.
So let's dig into reverse mortgages. And you've heard a little bit of the perspective that Bruce shared up front. We provide education, we provide knowledge and the insight and the pros and cons and the facts for you to be able to make decisions about what is most important and meaningful to you. There's always going to be costs and benefits to every decision. There's always pros and cons. There's always costs and opportunity costs if you do something that prohibits you from doing something else. And so in this world of decision making that we live in, ultimately, our goal is to make the best decisions given the situation at hand. And all of us are given a different situation. And today, what we're going to do is really just unpack what is a reverse mortgage, what is the lay of the land in terms of the bigger macroeconomic factors surrounding this idea of using a reverse mortgage. And then we're going to really just dig into some of the pros and cons and how it works in terms of what is a reverse mortgage, what can it help you do, and what are some things that you would need to think about before doing a reverse mortgage. So before we dig in too much, Bruce, you wanted to talk about just being a fiduciary and that perspective as we're handling people's financial lives. Can you just talk about that a little bit?
Yeah, what's interesting is, this fiduciary designation, which I am, is you have to pass a test, and then basically you have to promise that you're going to keep your client's best interests in mind. I frankly think that's a little insulting because I think a lot of people that don't have that designation probably keep their client's best interests in mind. But that's either here or there. That's what the Financial Regulatory Authority says. That's what the SEC says, so on and so forth. But even in that, things change. So could you be a fiduciary, a money manager? Fiduciarily, you have to pick what is the appropriate investment. But then you have to say to yourself, does that mean that I also should know what the tax bracket they're in? And that's a different type of fiduciary. Or if somebody actually prefers to have fixed income in the form of an annuity, that would be a different type of best interest in mind. And yet it's not covered under the same fiduciary responsibility. So does it mean that you have to talk to people about their trusts or about their medical directives? I think you should, but it doesn't really fall underneath that. Well, here's another thing that is starting to come to the forefront of if you're not talking to people about the benefits and the drawbacks of a reverse mortgage, then many people think you are not doing what's in their best interest. Example, and I have to give a big disclosure here. I'm not giving advice right now, but there are some people that would say you could actually do a Roth conversion. You can convert your IRA to a Roth. At the time, you pay all the taxes, but then don't take any money from other investment accounts. You could actually tap into your home equity through the reverse mortgage just for that year to keep your taxes low, so that you actually then don't pay as many taxes on the Roth conversion. So that's a strategy. If you're not talking to your clients about, then you're not doing what's in their fiduciary best interest, because you're protecting their portfolio from one of the biggest eroders of wealth, and that are taxes. And all this is legal, by the way. It's totally legal. So those are the things we have to consider when we're talking about reverse mortgages, or just some of the things we have to consider. There's all kinds of things.
Well, and along that vein, we're not giving advice. We're always bringing education. And ultimately, whatever you are working to accomplish, your set of circumstances, your financial picture, your goals, your objectives, your challenges, those all have to be taken into consideration before any decision would be made about what is the best thing for you. So today we're just talking about reverse mortgages, how they work. And if there's something interesting here today for you, then dig deeper and find out how it might apply to your specific situation. All right. So Mike, you've been on the show before. Tell us just a little bit about your background. I know you are currently the Regional Senior Lending Sale Manager for Thrive Mortgage, and you've been in the industry for 27 years. So you've seen a lot in this field of reverse mortgages. Just give us a little bit of backstory and how you came into this position working with reverse mortgages.
Well, technically, I've been in the mortgage industry for 27 years. I've been in the reverse mortgage industry primarily. That's all I do now. It's for the last 14 years. And I originally from the western part of Virginia, out in the coal fields, and met my wife there, who went to college out there, and followed her back to the East Coast here in Virginia Beach area. And we've been here for 39 years. Actually, just this past weekend, we celebrated 37 years of marriage. So I'm excited about that. I didn't think I'd live 37 years, let alone be married for 37 years in my younger days. But when I met my wife, her father was a retired Marine, and he was in the insurance business. So working as a heavy equipment diesel mechanic, your life expectancy was not that great, and your body parts kept deteriorating pretty quickly. So I looked at at getting into the life insurance, and I have been licensed in life, annuities, health, and insurance planning since 1988. So I like to say I'm old enough that I'm grandfathered in. I don't have to take CE credits anymore. So to some people, that's a big deal. But again, I got into the insurance industry, doing life insurance. Started doing it. I have a large family, so I started doing it that way, and just worked my way into the insurance industry. And 1990, I retired from a heavy equipment diesel mechanic, went full time. My father-in-law unfortunately passed away about that time, and I took over his agency. So I have an insurance background, annuity background, that kind of thing. And as I was probably in 1995, when I got in the mortgage business, I actually got in the mortgage business doing debt consolidation refinances using home equity. So I learned the power of home equity in helping people solve problems, restructure debt. Actually, it's not replacing debt; it's just restructuring. And then at some point, and then in 2008, when the wheels kind of fell off the mortgage industry and other industries, I went to work for a friend of mine, and he said, Mike, why don't you learn to do reverse mortgages? And I just, as most people know, and as Bruce was explaining, most people don't know what a reverse mortgage is other than a myth or a rumor that they've heard. And I said, I'm not taking advantage of old people. I don't need the money that bad. I make a good living. And once I got into it, started digging into it in 2008, and learned of all the valuable options that are available. Most people don't even understand that you can purchase a home with a reverse mortgage. Probably, I would say probably 35% of my business is people downsizing in their later years and looking to move closer to family members or reduce expenses from houses that no longer meet their needs and things of that nature. So that's how I got in the reverse mortgage business. And just a little tidbit, it's not been called technically a reverse mortgage since 1988. That's when Congress in 1988 passed a law called Home Equity Conversion Mortgage. You may hear it called a HECM. But at that point in time, it stopped being a reverse mortgage, but it was such a slang for the terminology, people still call it a reverse mortgage, even though it's a federally insured FHA loan that has all the protections of FHA and several other benefits.
Well, thank you for walking us through that. I think it's always fascinating to hear the backstory, and not only that you walked into working with home equity conversion mortgages, we'll shorten that to reverse mortgages, but that you walked into that not just because it was a good business move for you, but because you started seeing the power of using them for people. And so we're just going to really unpack that today. Can you kind of start from the perspective of looking at the big picture? You talk a lot about where equity is lying, specifically for baby boomers, which is really the people group or the segment of culture right now that this is most interesting and useful for. So can you kind of talk about what is going on financially on a whole within the US in terms of boomers and their money?
Yeah, well, like I said, it's called baby boomers. They call it seniors. And one of my jokes at my seminars, I said, since I became a senior, I'd rather be called baby boomer than senior. So I use the baby boomer terminology. But baby boomers are turning 65 at a rate of 10,000 a day for the next 15 to 18 years. If you do the math, that's 3.65 million a year is qualifying for age 62 or 65 or retirement, whatever retirement age may be now. I think Social Security, when I started taking Social Security, I had to be 66 in 6 months, and my wife is several years younger than me. She has to work till she's 77 and 67 in so many months before you get full benefits. And Bruce, we've talked about this before as an alternative to Social Security and when to take it out and when not to. But anyway, baby boomers are considered born between 1946 and 1964. And their currently age range is between 55 and 75 and up. Those who are over boomers, I don't know what they call them, but they're currently about 79 to 80 million right now in the United States, with another 3.65 million becoming eligible every year. Couple things of the baby boomer generation. 48% of baby boomers are retiring while carrying a mortgage into their retirement years. So they're trying to.
What's the percentage? You said 48?
48% are carrying a mortgage into retirement years. Another interesting fact, 50% of those 65 or older have their houses paid for, and 27% of those will downsize or right size into a home that better meets their retirement needs. So thus there came in 2009 when they made it a reverse mortgage purchase. And I did the first reverse mortgage purchase in the state of Virginia in August of 2009. Had no idea what I was doing. I was just winging it and asking for help and support. But that is a vast market right now these days because, like I said, 27% are going downsize. They're empty nesters. They're moving closer to family and friends. They're reducing overhead. They're saving money by, staying to save for medical needs or things of that nature in their retirement years. 70% of baby boomers are going to need some form of medical assistance during retirement. 6% have long-term care. So when it comes down to it, you got to determine if their siblings, if their children have $22 an hour for them to for assisted support while they're working at home. Do they have $30,000 for daycare? I mean, not daycare, but $30,000 for assisted living facilities. And it's $94,000 a year to stay in a nursing home. And I kind of asked the children, I said, if you don't like any of those answers, which bedroom is mom and dad moving into in your house? Because we all know the sandwich generation is there. We have the 27, 28-year-old, 30-year-old kids living in the basement while they got mom and dad in a spare bedroom trying to take care of them. And it's massively affecting the retirement of those 45 to 55 years of age.
So just kind of looking at that big picture, you're not just talking about the senior themselves. You're also looking at the generational planning, what's happening with their kids, and do their children, if mom and dad, who are boomers, don't have the financial resources, how are the kids going to be handling that? And so you're looking at a timeline of moving new people entering this challenge of figuring out financial needs and specifically income during the later years of their life, and figuring out how do we handle that income need most effectively. And if one option is not having $94,000, the kids having that to put mom and dad into a nursing home, where is the cash going to come from for these kind of needs? So I like that you're showing what those challenges realistically are looking like, especially being in that sandwich generation of taking care of aging parents and also taking care of kids in your home at the same time.
Mm-hmm. Well, another statistics is even though there's 50% have their houses paid for free and clear, those are over 65. There's the same statistics. 50% of baby boomers have saved less than $50,000 other than Social Security for retirement. And the thing about it is we've got to look at the Gen X's that are coming along right behind them from 65 through 80. They're turning 45. They're hitting the 55, 57 range, and they're right in that area. Because when I talk to financial planners, sometimes I say, when you talk to a financial planner, you need to ask them, we're putting together a program for you and your family. But what's that going to do to your retirement income if you have to start taking care of mom and dad? And most of them statistics are saying that if they have to start taking care of mom and dad out of their own assets, and they're not leveraging the equity that's in the baby boomers' homes to supplement to take care of the kids, their fat parents while they're in the homes, it's going to push their retirement back anywhere from between 3 to 7 years, because they're going to have to use funds that they were planning on putting in. So it's a unique type market. And just for those who don't know, there's a non-FHA insured product out there, reverse mortgage from private investors, that's not FHA insured, but has all the FHA guidelines. And it starts at age 55, not 62 anymore. So people 55 in specific states can start tapping into the equity, and it's designed to work for the mass affluent clients, and we can lend money at closing on these proprietary products up to $4 million at closing. So I've done a couple of paid out over $1.5 million at closing.
Yeah, that was where I wanted to kind of just pivot a little bit, because we're kind of going down the road that this is to solve financial situations that people have gotten themselves into that aren't great. It's one way to solve it, but it's also strategies for more affluent people also.
Absolutely.
So I want to make sure people realize, and they don't turn off the podcast and think, well, I already have enough money to take care of myself and my parents, so I probably don't need to listen to this. But there are other strategies for the affluent people here. So Mike, before we go any further, let's just talk about the home equity conversion mortgages, the basics of it. Like you just mentioned the 55, but what is the basics of it from an age, and then the other things to consider to actually do an application to get a mortgage. Okay. And then we'll go down the rabbit hole about, what happens if you don't stay in the home, and does the spouse get the same benefits and all those things?
Well, right now, to be a borrower, the borrower has to be 62 years of age minimum. It is a mortality or equity-based loan. The older you are, we take four things into consideration. We take into fact their age, which a borrower has to be 62 to qualify. We take in the value of the home, and we take in the interest rate on the loan and how much equity we're going to have to leave in the house to get our interest back one time, because it's a teeter-totter equity-based loan. We say if you have 26 years left to live, and based on your mortality table, or 14 years, that's going to at a current interest rate of X. Then we're going to need to leave 154,000 in equity to get our interest back if you were to live to age 100. And we take everything to the extreme. So they have to be 62 years of age, and they have to own it as their primary residence. And if they are a married couples, only one has to be 62. So if we had a 66-year-old and a 59-year-old, we would base the mortality or the life expectancy on the 59-year-old. And that's how much we would project, how much equity we're going to leave in the house. So based on the mortality type situation, the older you are, the less number of years you have to live, the more of the equity we can give you, because you'll accumulate less interest. The younger you are, we'll give you less of the equity out of your house. We have to leave more in what we call residual equity in the house to get it, because we only get paid back one time. You pay back the principal and whatever interest accumulates over X time frame. So if it's over 5 years, they pay us back the interest and the initial loan amount, and the house goes to the heirs. It is never ours.
Okay, let's because this is one of the biggest misconceptions out there, Mike. So let's just emphasize this again. So if the heirs, well, not if, when the house, the contract is over or needs to be paid back, it can be paid back in a variety of ways, right? One of the ways is most common, I would think, is the house is put up for sale, and then the interest is paid back, and then the balance of that goes into the estate.
Yes.
Okay, so let's just say that again. Okay, so the bank is owed interest that's been accruing all these years, and you sell the home, you pay the interest off, and if there's anything left, it goes back into the estate.
Absolutely.
No different if the person would have had a regular mortgage and the house was sold and whatever equity was still in the house goes to the estate. There's absolutely no difference.
None.
Because you had to pay off that mortgage with the sale of the house. I'm sorry I'm being so second grade elementary on this,
Okay.
but
No, this is really good, because I think it can get really confusing.
yeah, this gets really, the part that people are just, they want to start some kind of controversy because Mike, I often say, people often say about things they've heard but not actually experienced, because if you experienced, you wouldn't even talk about it. But you want to pass along the bad things because you think you know something about something. And this is just isn't true. The other thing that you could do, Mike, is one of the children, or heck, the next door neighbor, anybody that wanted to, they could actually just take assets themselves and pay the bank off and still retain the house if they want to.
Absolutely.
Yeah. So let's reiterate that. If one of the children wants the house, they don't have to sell it. They could actually just take their own assets. They wanted to keep it in the family, pay off the bank, or frankly, I guess, Mike, they could just get a regular mortgage if they wanted to.
Absolutely. They get a regular mortgage, assets, whatever they want, as long as that debt is eliminated.
Right. And then it's their house. Now, Mike, one of the other things, let's go over this, because people say this all the time. Yes, but if the house doesn't accrue in value or it's underwater, what happens then?
Well, there's a unique feature in a reverse mortgage, and FHA and the other products as well, but it's called a non-recourse feature, which means and states that no one is ever responsible for paying the home back personally. Only the equity in the house can ever be used at the time the loan is due. The time the loan is due is when the last of the two borrowers, husband and wife, no longer live in a property as their primary residence, or one of them passes away, or they sell the house, or they refinance the house, because you can do with this one anything you want. It's just a lien against your property that we've leveraged, we've left enough equity in the house that will leverage it to have enough equity to get our loan back. So with a reverse mortgage, there is the children. A lot of times I'm working with one right now, Bruce, where a 96-year-old just passed away. Their daughter is 77 and the property is due. Mom took such a low loan. We're doing a reverse mortgage for the daughter to pay off the mom's reverse mortgage. And the daughter's going to live there with no mortgage payments. So it's a standard FHA loan, guys. You have to pay your property taxes. You have to pay your homeowner's insurance. You have to keep it in a reasonable livable condition. And those are all standard FHA guidelines. Nothing unique about a reverse mortgage.
So
okay, so
I was going to say, can you just walk through some numbers? Like, imagine, like, for example, I know that we had one comment on a previous conversation we had done. What if you purchase a house for cash, you're over 62, the value of the house is now 225,000, or maybe you can use those numbers, or you can work that into a different financial situation as well. You purchased cash, you have a value of the house now, you're over 62. What does that look like? What are your options in terms of taking a reverse mortgage? How much equity might potentially need to be kept in the house of that total value?
Well, again, as I mentioned a while ago, interest rates are effective because it determines how much equity, how much interest is going to accumulate. Recently, we all know that the interest rates are going up. I was doing loans for 2 3/4. I did one yesterday for 5, and they're 5.5%. And it's nothing unusual. The first mortgage I did in 1986 was on a VA assumption, and I paid 11.5 to assume an ARM. So rates are not ridiculous. It's just different to what they had. But the thing about this, let's use a $300,000 property. $300,000 property near 62 years of age, based on today's interest rates, we could give them about 45% of the equity in their home. Now, if they are 75, we can give them about 50, maybe 52%. If I'm meeting with a couple right here after this meeting, they're 94, and we're giving her almost 70% of the equity in the house because they've got less number of years to accumulate interest to be paid back. So we have to leave less and less money there. But they have 62 years of age. They live in as their primary residence. They keep it in livable condition, and they pay taxes and insurance just like they would when they own a home free and clear. There's no magic potion.
Yeah. So Mike, let's maybe clarify this. So when you say you're going to give them either 45, 50, 55, depending on the age or this equity in their home, are you saying that they are now also not going to have a monthly mortgage payment because the equity is going to pay the mortgage payment? And will they also have some access to that equity, either in a lump sum or in a line of credit?
Yeah, there's 4 ways of taking money out of it. It could take the lump sum. There's 2 options. There's a fixed rate option, and whatever you take out on a fixed rate is the maximum you get. There's no more funds available. On a line of credit, on a adjustable rate, there is a line of credit. So let's assume on the 300,000 that they're 75 years of age. We've taken out the closing costs, which are always rolled in, and now they have, let's say they have 120,000 in a line of credit. Now they can leave them. They can take that 100. They can take 60% up front the first year. The second year, they get the other 40% after 13 months. That's something FHA came up with to keep from people taking all the money out up front. And, we always hear about the children saying this is a bad option, but the first time they know mom and dad's got $100,000, they kind of get a little closer to mom and dad because they need something for themselves. And I'm not saying it's wrong. I give stuff to my children, to my son all the time. But the thing about it is they put that little safety valve in there and you can only get 60% the first year, or up to the amount that it takes to rectify or pay off their current mortgage. So let's just assume they could take out of 150,000, they could take 100,000 the first year, and they'd have 50,000 in a line of credit, and that's available to them the second year. They could also have just a line of credit and only pay just a closing cost and leave that line of credit in there. Right now, Bruce, which as I talk about interest rates being high, if we're charging a client 5% on the money that they borrowed, like a HELOC at a bank, their line of credit is growing at 5.5%. So we pay 0.5% more on equity, not the appreciation value. Equity. There's nothing on the market that you can get 5.5% on the growth of the equity of your home, income tax free, that's accessible to you anytime in the future, forever, as long as they live in the property. Now they do have two other options. They could take what we call a tenure option, which a tenure is a life expectancy payout. Let's assume that we run our numbers, and based off their life expectancy, the pool of money that they have, we can give you $800 a month for as long as you live in the house. Now we're projected on your life expectancy of 86 to 88, depending on male or female. But if you live to 120, we're still paying that money, even if there's zero equity in the house. There's nothing that does this out there. Number two, if $800 a month is not enough, they say, Mike, I need $1,100 a month. Then we'll restructure it as a term payment or a term certain annuity, like a term certain annuity. As long as they live in the house, we'll pay them that $1,100, may pay them out $1,100 to pay them out for 12 years and 3 months. At the end of that point,
that's the term. That's the term portion. The term
right.
is how long you determine you can make that extra payment.
Right.
For them.
But a tenure payment is based on life expectancy, and we pay it out. And it's like a life insurance policy or annuity. It's based on mortality cost. Life expectancy. How long do we expect them to live? How much interest are they accumulating? How much do we have to leave to cover that interest? So
now, Mike, so say we're in a situation, I just wanted to ask this side question here. Say you've made a decision to use the tenure payment. So it's a smaller dollar amount that you're getting per month, but now you need access to a lot more capital all at once. Can you change the terms of the reverse mortgage while it's already in effect, or do you need to do another reverse mortgage?
Now, if you're going from line of credit to tenure to term, you can change it back and forth as many times as you want to. You can be taking $800 a month and you say, I don't need $800 a month. Let's just stop it and let the line of credit grow. Because it's a pool of money. You got to understand, when we calculate this money, the pool of money, we're actually paying out more than the pool is worth, because you got to remember, as long as it's in the pool, it's earning 5.5% or whatever that number may be. So we only may take out, we have a pool of 55,000 and pay out almost 68,000 because it's earning money while you're not using it. So anytime you stop, you can start making payments. You can stop making payments. You can take a lump sum out of your line of credit. You can go back and recalculate the 10-year payment. You can go back and recalculate the term payment until you take it all. You can change it between the term, the line of credit, and the tenure anytime you want for a $20 service fee.
And then another question on that. How is the line of credit earning and continuing to grow? On what basis is it continuing to grow while you're not using it?
This is one that the IRS and HUD and them are trying to figure out. They made a statement years ago stating that the equity in your home is grandfathered to grow at 0.5% higher than the actual value that you're paying on the loan. It's just something they came up with years ago. And I get that all the time. And they get people say that's too good to be true. And I go, it sounds too good to be true, but it is the fact. You're earning more than, so even if your house is worth 300 and your equity is growing at 5.5%, if your house is now worth 600, 10, 15 years down the road, you've got that line of credit growth and you've got the appreciation. So it's a unique feature. Even if there's a downturn in the market and the house goes from 300,000 down to 200,000, and when they pass away, they now owe 250, but they owe 250, but the house is only worth 200. The only thing that we can recoup or FHA can recoup is the equity that the value that the house at the time the loan is due. So if they owe 250 and it's worth 200, FHA is on the hook for the 250 for the $50,000 difference. The bank is getting their money back, the 250 that's owed to them. The FHA upfront premium that on all FHA loans is there to take care of things like that. The unique thing about it is if you owe $50,000 short on a traditional mortgage, traditional FHA, and it doesn't have a non-recourse feature, if you owe 250 and they let you short sell it for 200 because that's the value, they'll let you do that. But next year, that $50,000 that they gave you as a short sale, the IRS comes back and tax that onto your income as taxable income. But with a reverse mortgage, there is no such recourse. I mean, if the clients have $1 million worth of life insurance that they're passing to their children, and they don't want the house, and it's upside down by $50,000, they just do a deed in lieu and walk away from it. And nobody is ever responsible for paying the loan back except the value of the house at the time it's due.
And once again, I don't know if you caught this. This isn't magic. Mike uses that. I use that word all the time, Mike. It's actual actuarial science, and they charge a fee, the FHA, for this, so that part of that fee that's charged on all these loans, it goes to cover situations like what Mike just explained. So it's not like the FHA is going to, well, they might run out of money because of poor handling, but then they'll just go to the government because it's government backed, and then the government will just tax us to recoup all that. So by the taxing power, but the point of the matter is that they have contingency built into fees. Now let's talk about, I know the fees are different, but let's talk about fees in general, because that comes up all the time. Oh, you don't want to do, and I'm going to get on a little bit of soapbox about this, because people say, oh, you don't want to do this because it has high fees. And I always say that everything has fees, no matter what you have. Even if you buy a can of Coke or Sprite, it has a fee, which is the price. But if you get what you want, why does the fee matter? Because if you want it, you have to pay something for it, whether it's 75 cents for a Coke or $10,000 fee for a reverse mortgage. So let's just talk about the fee structure in general.
Okay. Now, uniquely, the first quarter of the year, well, actually, beginning the second quarter in March, the loan value on reverse mortgages, every time FHA does a step up, most of it's based on county or state, how much FHA limits are. Reverse mortgage is a nationwide. They just increase the loan value, not the loan value, but the value of the property. The maximum value of the property is $970,800 nationwide for reverse mortgages. Plus the jumbos or the proprietary products go from there over 4 million. So the value of the homes keep increasing, and the equity is just used for that type of situation. What else do you want to know, Bruce? I'm sorry.
Just the fees in general. What are some of the fees?
Okay.
And then also approximately how much they would be, and so on and so forth.
It runs roughly 6 to 6.5, maybe 7% of the total value of the property, because the fees are based off not the loan amount. The FHA insurance premium is not based off of a $300,000 loan amount. It's based off of 2% of the appraised value, because you got to remember, these things are compounding. The interest is compounding on it. So we got to make sure there's enough there. So when you go to closing, we take it, the deed amount that's charged is 150% of the value of the house, but there's 2% up front. There is the standard closing cost on any traditional loan in your local area, the taxes, the transfer fees, all those things. And we can charge, FHA allows us, and we're capped by FHA, the maximum we can charge on any loan is $6,000. It's 2% of the first $200,000 1% of the remaining balance up to a maximum of $6,000. So I did one for a lady and she was saying, "Oh, Mike, the fees are just way too high." Well, this is a lady, and you run into all kinds, guys. You run into people who need it, and you got people who just got a house paid for and they just want to use it. She still has a Citation jet and a Lamborghini, but she wanted $600,000 out of her house because it was hers. And she took it. She bought a condo in Florida. Now she lives half the time in Florida and half the time in Virginia Beach. So, but the fees are there, but it's in comparison to what? Yeah, the 2% upfront fee. Let's say $600,000 house, 2% is $12,000. Okay, that's getting you the non-recourse feature though. So would you rather pay $12,000 or have the house be upside down by $100,000 because your parents lived a long lifetime and now the kids are saddled with that $100,000? So it's what the cost is. So it's the 2% upfront FHA fee, our origination fee, and the standard closing cost. Now people say $6,000, that's a lot for you. We're only getting paid one time, guys. So we've got to take care of all this and make sure that everybody has to be profitable. We help a lot of people, and we'll do, I have financial planners that send me a loan and all we're doing is collect, we're getting paid on $30,000. It's not making a lot, but for that financial planner, you have to be with financial planners. They are technically my clients because I'm structuring the program to meet the needs of their clients. So if they need to pay off an $80,000 mortgage, they need $20,000 to eliminate debt, and they need a line of credit. If that's what they want, that's how I'm going to structure it because that's the best need for the client. Back in the old days, they took the whole amount. There was a lot of fees and people run through a lot of money and they didn't have money that when they needed it in the future. But we work more and more with the affluent and the elder law attorneys, estate planners and things of that nature, and working with trust now. We work a lot with trust when they were a big taboo back in the past. You couldn't do well with the trust, but those are the basic costs of the loan.
Yeah, there's once again, I'm not a CPA. I'm not suggesting this as a tax. This is a disclosure. Talk to your tax accountant. But a situation that a more affluent family might do is they want to obtain something, an asset. It might be a Lamborghini, as you talked about, or it may be a private plane to fly back and forth. And they have a brokerage account where they have a lot of capital gains in it. And so they don't want to sell the capital gains or the stock because of the capital gains, which will cost them a 20% minimum and then probably 3.2 Medicare surcharge. So almost 25%. And so what they could do then is do the home equity conversion and actually then access the equity tax-free to actually purchase this. So even if the fee is, what'd you say, 5 or 6% of the loan, they're saving almost 25% in taxes.
Absolutely.
So
you
tell me if it's worth
it. We've went over sequence of returns in the past. Sequence of returns right now is a big thing because the market is up and down. And if you're a financial planner and you've told a client that they have a pool of money and they can take $8,000 a year out of it, and because of the return they were getting in good years, what happens when there's a negative return on your money? If you keep taking money out of that pool, taxable income out of that pool in a negative environment, those clients are selling off assets and they'll never be able to buy it back at that same price. The pool will never get back to where it needs to be for them to retire. And financial planners are depleting their assets under management, which is where their income comes from. So the assets under management, we all talked about Dr. Wade Fowle, who talks about a buffer asset. That's what you were talking about. It's another source of funds. And right now it's hard to get 5.5% on your returns. So you got another source of funds, 5.5% return. And it's income tax money, it's income tax growth. And anytime you take it out, it's income tax free. So in a down market, instead of selling off stock to make up a $40,000 short sale, with these affluent clients, you just take $40,000 out of the line of credit and take nothing out of your portfolio. If you do that 4 times over a 25-year period, people say, well, I'll just take a reverse mortgage as loan of last resort. Well, if you do that as loan of last resort, that your reverse mortgage funds run out in about 4.5, 5 years. It's statistically been shown that out of the Monte Carlo scenarios, that if you take the money out in those 4 years of a bear market and take the rest of it out, not counting the money you have left over in the equity, your account will grow more than it would if you didn't have a reverse mortgage. It's just
proved,
assets.
Yeah, I just proved that last night to a client. The other thing that people that don't realize is that, let's say you have a $2,000 mortgage, that's $24,000 a year. How hard do your assets have to work to pay for that mortgage? So typically, and we don't go by this, but historically, people would say you were going to get a 4% return on your assets. So 4% on 600,000 is actually 24,000 that you need it. Well, actually, we have to pay the taxes on it depending on where it is. But let's pretend we don't know where the asset is, so we can't determine what the taxes are. But you'd have to have a minimum of $600,000 that your assets would have to generate $24,000 a year to pay for your mortgage. So if you didn't have to pay for your mortgage, that extra $600,000 could be used to actually just allow it to grow, which potentially it could grow more than your home anyway as an asset. So all these have to be, you actually have to sit down with a competent professional, both as a home equity conversion mortgage professional and your financial professional, to actually weave in all these different strategies. So I think we've kind of cleared that. Rachel, there are a couple of other questions from the last podcast I think we ought to touch upon. And Mike,
there are.
The one is about
go ahead, Bruce.
The renting the home. So I saw somebody said, well, you get a reverse mortgage and then you can actually then go purchase something else or go rent yourself somewhere else. And then you could use the home as a rental property. I think I know the answer to this, Mike, but you can use their home as a rental property and then it has no mortgage on it. And so you actually accelerate your gains, but I don't think they're going to allow that.
That's called mortgage fraud. Yeah, and that's set up in the guidelines it says you have to meet the guidelines of the reverse mortgage. The guidelines of the reverse mortgage, you have to pay property taxes, homeowners insurance, keep the house in livable condition. It has to be your primary residence or your spouse's primary residence. Now you can have an individual, one spouse can be in assisted living while another one's living at home. Now, here's a key thing about that, Bruce. If you got a wife living at home and you happen to go into rehab or assisted living, that reverse mortgage still rolls forward. It doesn't go away. And there you have income tax-free money that you're not taking away from your portfolio for whatever needs that other spouse has. So, it is too good to be true in a lot of features, but it's just the way it's set up.
Right. Now let's clear this other one. This was a big one. They said, because this person was right out adamant, this is not true, that the non-borrowing spouse has the same right as the older spouse.
Or the borrowing spouse.
Well, yeah, that would happen to be older, so on and so forth. Does both spouses have to actually be on the mortgage?
No.
Do both spouses have to be on the deed?
Technically, no. We can there's a deferral period after the borrowing spouse passes. If they were married at the time that the loan went into effect, when they pass away, they've got 90 days to defer to be put on the deed. You can put them on the deed once the loan's done. It's not going to affect the loan amount because you're younger. We're already talking to them. We're already taking into consideration that is their spouse. It's called a non-borrowing spouse. There's a non-borrowing qualified and a non-borrowing non-qualified. Non-qualified, you don't have to count their age if they're in an assisted living facility and they're never going to be in the house. If they're qualified living in the house, then we have to count their age. Now, the two differences that Bruce is, number one, if there's an older husband and a younger wife, and they're both on title, the younger wife does not have the same benefit as the borrower. Here's the difference. The borrower has the right to the monthly tenure payment or the term payment or the line of credit. The non-borrowing one does not. But what the non-borrowing one is guaranteed, that at the time the borrower passes away, she will be put on the deed. She will have full access to the house to live there for the rest of her life with no mortgage payments, but any monthly payments coming in may go away. Well, unless it's an accident, Bruce, a heart attack, and they get killed in a car wreck, if I'm a spouse and I've got a $400,000 line of credit or $300,000 line of credit, and I know I'm terminally ill, there's no way I'm not going to take that $400,000 that's mine, transfer it into my checking account, which my wife has access to it. Now that funds are hers. And since she's married, you have to go back to the step-up basis, get with your accountant, get with your attorney on what portion of that would be taxable to her, but very little of it's going to be taxable, in my opinion. And I'm not an attorney nor a tax advisor, because it's his assets being shared with his spouse. So if you know it's coming, take the money out, put it in there. When he passes away, she's got all the funds, and she still gets to live in the house with no mortgage payments. We talk about mortgage payment, no principal or interest payments. CFPB will not allow us to use the statement mortgage payment because they consider taxes and insurance and HOA fees as a mortgage payment. What is
interesting?
It's not. No principal or interest payments.
Okay.
Or due.
Of course, you use the line of credit to pay for your taxes and insurance if you had it.
I know people that take out the monthly at the end of each year. They may have it in a line of credit. At the end of each year, they take the amount of out their line of credit. They take it out to pay their taxes and insurance, pay a one-time lump sum. We can actually set up a side account, or what we call a LISA, a life expectancy set aside, that will set up a pool of money. Again, just like a retirement pool, we don't have to put as much, but we'll pay their taxes and insurance to their life expectancy. So if their life expectancy is 88, they have no principal or interest payments, no taxes or insurance, because those are being paid from that pool until 88. They turn 89 or beyond their life expectancy, taxes and insurance has to be paid again.
And Mike, that pool of money is making 5.5%, isn't it? I just want to be
compounding annually, income tax free. It's available to you with a phone call or your power of attorney's phone call. It will be directly deposited in your checking account within 5 to 7 business days, income tax free.
Well, this definitely is a lot of information for somebody to explore, especially if they're in a situation where they realize that there is a lot of equity in a house that could be being used, and you're in those senior years of over 62, if this is the typical FHA, or you said over 55 with the private
proprietary ones, yes.
In some states, and you said that's not available in all states, correct?
Not in all states, no.
So a lot of information, a lot of potential options. Mike, if somebody is interested in finding out more information, can you tell them how to get a hold of you, where they can find you, what resources and information you might have available to them, and how they can ask you questions if they would like to pursue this more directly with you?
Well, as I always do, my number is my personal cell number, 757-646-4147. Again, that's 757-646-4147. I answer it 24 hours a day. My wife doesn't believe it, but I do, but I answer it 24 hours a day, even if I think it's a spam call, because I get calls from all over the United States. Mike.Stanley@thrivemortgage.com. But the best way is text me or email, text me or call me on my cell. That's the best way to communicate.
Excellent. Well, thank you for sharing all of this today. And I think we could chat much longer. Bruce, is there any other questions? I mean, I know that we could have talked more fully about what the options are for a non-borrowing spouse. We could talk also about the purchase mortgage, reverse purchase mortgage, I think is how you reverse purchase.
Right. To actually purchase a home with a home equity conversion mortgage. I'm trying to change my verbiage for you, Mike.
It's okay.
Home equity conversion
okay.
mortgage.
We've actually rebranded our name here at Thrive. We're called Wisdom Senior Lending Division. And we're trying to say it's not a reverse mortgage, but I just want to get 2 paragraphs in it before somebody says, oh, it's a reverse mortgage, and they shut down. As a little side joke, as I told you before, I've traveled all up down the East Coast doing seminars for large mortgage companies and talking to the largest Merrill Lynch office in North Carolina. I've talked to the largest Keller Williams agencies in North and South Carolina, from Maine to Florida. And the thing about it is, I always kind of start off my little seminar, and it's a little corny, and I'm going to show you what it is. I say, if you've heard anything negative about a reverse mortgage, they all raise their hand. I said, raise your right hand, stick out your right thumb, put your right ear, and flush what you know for about 30 minutes. And we'll go from there. So the thing about it is, if people was actually, I wrote an article for HURRAH, the Hampton Roads Real Estate Association. I did an article on alternative financing for baby boomers. I teach the SRES, Senior Real Estate Specialist. It's a designation that realtors have to get to work with seniors. So I teach the alternative course of that, and I can give you several financial planners and elder law attorneys that I've worked with. So it's not too good to be true. There's 10.6 trillion sitting in baby boomers' houses. And it can be used for anything. You can buy whatever you want to with it. They ask you not to do a high risk investment, because back in the day we had investors who were reverse mortgage specialists, or we're doing reverses, and they'd say, okay, give me 60,000 equity in your home, and I'll put it this risk. This product's going to earn you 22%, and 19 months later it's gone, and so is their equity. So it's as you know, Bruce, with the fiduciary side.
Now best interest hopefully eliminates some of that.
Yeah, it does. It does. Yeah. But guys, if you, like I said, people have heard that my great aunt in Arizona lost her house to a reverse mortgage. She either took it out prior to 1988 or she didn't pay her taxes. It had nothing to do with the reverse mortgage that we work with now, the HECM product we work with now.
Yeah.
Well, this is really helpful. Thank you so much for being back with us again today. And I know that we're going to have more questions through the YouTube channel and through the podcast. So let me just make sure that if you're listening, you have options and the channels to be able to get a hold of us. So you can always put your comment your question in the comment section on YouTube, on Facebook, on LinkedIn, on Twitter, wherever you are watching this video. We're also going to be live on the podcast channels later on. And so if you are listening to the podcast, you can email us at hello@themoneyadvantage.com. You can always get answers to your questions. And if we don't have the answer, we will find the answer for you. So there is valuable resources, there are options, and this is a tool that can work in a variety of situations and can do a lot of good. And so it's just exploring what that may look like for you in your particular situation before you can move forward with confidence. So thank you for being with us today. We appreciate you on the show with us, Mike, and thank you so much for joining us today.
Thank you both. It's been my pleasure. Thank you so much.
Thank you. In closing, remember, success leaves clues. So model the successful few, not the crowd, and build a life and business you love.